Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Joe. It's fantastic to have you on the podcast show.
Thank you, Bilal. Great to be here. It's good to see an old friend.
Great. Now, before we go into the meat of our conversation, I do like to ask my guests something about their origin story. So it'd be great to hear in your own words, what you studied at university. Was it inevitable you'd end up in finance and economics and some of your key career milestones?
When I went to college, I had signed up thinking I would be an econ major in a liberal arts school. And therefore, I was assigned an advisor who happened to be the chair of the econ department. After one class, I hated it. And the advisor said, well, this was a visiting professor. Wait till my good graduate school friend will be teaching, and just take a class with him and see if you like it. And of course, as with many things, if you have a good teacher, it can make somebody's maybe what one would consider a dull subject matter very interesting. So I was lucky to have picked economics and then finished with it, and of course, have a career in economics.
Great, fantastic. And then was it inevitable you'd end up in Wall Street or not? Like, were you thinking of academia
I
or
thought
were you
about
thinking
I
about...
thought about academia. Yeah, I thought about academia. I mean, it's sort of that professorial life kind of was appealing, kind of a little bit like, a romanticism associated with like the Dead Poets Society, and had some great teachers in school. So that was something I considered. But unfortunately, as I learned too late in my college career, that grad school PhD programs is basically all math, or as I guess you'd say across the pond, maths, pluralized. We joke about that here, obviously, but it was all math, and I realized, wow. And I was told by many people, actually, if you go to grad school in econ, you really learn math, you don't learn economics. So that was sort of a disincentive to go right into graduate school post college. So I wound up doing some work part time, post grad work part time, and then was working at the New York Fed, and then through a series of just different people approaching me, sort of found my way onto Wall Street. And it actually worked out, I think, better than had I declared my career to be a professor. Although my parents are teachers and they like it, they were pretty happy that I actually wound up going to the private sector. So I guess knock on wood, as we say, it all worked out okay.
That's fantastic to hear. Now you've had a sort of a very sort of colorful and varied career. You've been very successful in the private sector, but also you've done some work for the administration, Trump's administration, in his first term. So it'd be great to hear. There's so many stories around the Trump administration, and there's positive and negative views. So what was it like working in Trump 1.0?
It was, well, here's the thing. There's a little bit there's a little bit of truth in everything. I mean, the thing is, it's sort of like, the word that people used in the first term was like chaos. But, if you go back and look at the earlier administrations, Clinton administration stands out. That word was used a lot. And I don't think it's exactly the right word. I mean, it did feel chaotic at times, but we were also in the middle of a pandemic. I was there the last year, so I got the pandemic year, for better or for worse. But what I learned was that the president is very open to different viewpoints. So listen to many different people, and there really is not, if good ideas would find their way to the top very quickly, and that made it feel sometimes that there was not maybe a structure that was very linear in terms of, you follow these bureaucratic protocols where it goes from one entity to another up the food chain. It was very entrepreneurial in that regard. So what you wind up learning is how people sometimes color things in the press isn't particularly accurate. And, while at times it might have felt like the president was a one-man band, he was getting good advice and was taking advice from everybody. So I thought, again, maybe I'm biased, but I didn't think the press was particularly fair under many of the circumstances that at least I was there. And I think this time around, what we're seeing is certainly an administration that's definitely much more, they're much more knowledgeable, they're much more prepared, they're much more strategic. But I enjoyed it. I thought it was great. It certainly proves that money doesn't buy happiness, because when you're in the government, the pay is pretty de minimis. But I love the work and the people, and I thought it was a really cool, neat experience. I'm really happy I did it. That's great. I've got great memories. Yeah.
Yeah, and you mentioned the current administration. So, I mean, one of the big debates we're all having in markets is like, how much can we use Trump 1.0 as a guide to Trump 2.0? And it does feel like something's very different this time around. And so
Yeah,
from what you've seen, obviously, you're looking outward
right.
into it, and you've got some
Yeah.
insights as well. I mean, how would you characterize Trump
So,
2.0?
well, to me, the having been there 4 years, having President Trump being in power for 4 years and having been 4 years in between, um, he is extraordinarily knowledgeable about many subjects, which he obviously would not have known that much about the first time around in terms of foreign policy and geopolitics, more specifically, and attention to detail. He knows all about that now and has a much better idea, I think, of how he wants to be effective, either through executive orders and even policy. So he is, I don't know what the right word is. I say he's more serious. I just think he's having had the experience. He's just much more thoughtful and use the word strategic and having an idea of how he wants to accomplish his goals. And it wasn't clear the first time around, in part because presidents the first go around just don't know a lot about how things work. So he is much more thoughtful on how he wants to get things done. They're much more prepared. You saw that in terms of all the executive orders that went through. And the difference, I think, with the other difference between now and the first time is that even though the congressional majorities are lower, they're narrow in the very narrow, obviously, in the House, and they're still pretty tight in the Senate. The party is more Trumpy. In other words, there are a lot more Trump populists in the House and in the Senate. He's got much more support than he had before, and you could see he's much more able to exert his will on the party because I think the party realizes he has a real meaningful mandate to make change, and now is much more knowledgeable about how to do it. So when he tweets and says things on social media that suggest he might do this, people are taking it more seriously because they know that there will be more follow through. It's not just sort of I don't want to say empty, but I think the first go around, people maybe after a while ignored it. This time around, they're realizing no, the president has a lot more power and a lot more ability to get things done and has a much stronger base of support. So I think all of it, everybody's taking him a lot more seriously now than before. And he has in his cabinet, I think the difference between this time around and the last time is he's got people really who buy Bilal into his agenda. And that wasn't the case in the first go around. I mean, in my case, I was lucky because former Secretary Mnuchin, Director Kudlow, Larry was my direct boss. Larry reported directly to President Trump. He had a lot of really good people on the finance side, and clearly he's got great people now with Scott Bessent at Treasury. Kevin Hassett, who I know was at CEA, came back now to take Larry's old job. And some of my other former colleagues are there in senior positions within NEC and other spots. So he's got those people, many of which he brought back, who are excellent, and new people like Scott Bessent, excellent choices. Obviously, you'd agree in the market, a lot of tremendous credibility. But I think in other cabinet areas, he has people that buy into his agenda. And what I think the president realized the first time around versus the second is that you need loyalty. Loyalty is key, and you need competence. And I don't think he had that in a lot of previous cabinet positions in the past. Certainly, he had people that I don't think shared his vision. I think he realized from the first go around, it's integral to get the people that share your vision and can implement your policies for which you were elected for.
And then in terms of his economic agenda, there's a couple of planks that we can kind of see emerging. One is tariffs, the greater use of tariffs. Another one is to clamp down on immigration or illegal immigration. Then there's another on taxes. Of course, the fiscal bill has passed the House now. There's questions around what's going to happen to the fiscal balance. So maybe let's start with those three, and then maybe there's some others that you think we
Yeah.
should also sort of
So
talk about as well.
when you talk about Trump 1.0 versus 2.0, and there are certainly differences, much more experience, and you can't put a price on that. And again, he had 4 years to think things through, so it's not just one term, second term. He really has gained so much knowledge, and I think that's what's made him so effective to this point. But the general notion that the president is very transactional, wants to make deals, and wants to negotiate deals, and is very businesslike, that hasn't changed. And the fact that the president wants oftentimes to be predictably unpredictable, he's not going to show you his cards, makes him an extraordinarily good negotiator, in my opinion. So those things haven't changed. And there is still also a little bit of an element of, there was a famous quote during the earlier campaign back in 16, well, take the president seriously, but not take him literally. There is some still element of that that's present where you clearly we're taking him very seriously. And, literally on some things, he made some comments on geopolitics where he's even said he's joking. We still have a tendency in the press sometimes to take him too literally. But as it relates to economic policy, I do think you've got to take him literally, and that tariffs are going to be used as a policy tool. I look at three avenues with which tariffs will be used. One is a negotiating incentive. We want to get two parties to the table, let's say Mexico and Canada, as it relates to border security, and I'm going to tariff you unless we reach some agreement. So one is a negotiating tactic. Secondly is raise revenue. We've got roughly $3 trillion of goods imports per annum. Let's say 10% across the board tariff, clearly at least in year one, could net you $300 billion. So there's certainly a revenue component to it. And also, to the extent the president wants to reindustrialize, which I believe he does, you would need tariffs as an incentive to move to the U.S. And the fact that, let's say, tariffs in China will be much higher than elsewhere, at least that's what I'm led to believe and what the president said in his campaign speeches, also means that the U.S. wants to decouple to the extent they can from China, because the connectivity we had during the pandemic with personal protective equipment, pharmaceuticals, was such that, wow, there are national security issues as it relates to China as well. So if you can get some of those supply chains out of China and bring them to other spots, even if they're not coming back to the U.S., that's a positive. So but the question is, will the president follow through on a reciprocal approach, which is where he's leaning now, or will it be a more two-tiered structured system as he proposed during the campaign? Let's say 60% tariff on China, 10 to 20% tariff on everyone else, or has that been abandoned? I don't know the answer to that. I don't think the president exactly knows. It could depend in part how these budget negotiations unfold. If tariffs are needed as a meaningful revenue source, to the extent they're needed as a meaningful revenue source, not in terms of congressional scorekeeping, because if it's not part of the legislation, it won't be, but to get some of those fiscal conservatives on board, you might need the tariffs. But at the same time, if you get some real meaningful cost savings on DOGE, Department of Government Efficiency, of which I'm optimistic on, then that may lessen the need for some of their revenues. So everything is up for discussion. Everything is up for debate. I don't think the president knows exactly the timeline, or more importantly, the sequencing about things will get done. And that has added an element of uncertainty in the markets. But I think, beyond that, it's hard to say, other than the fact that the president wants to pursue strong growth. He does look at the equity market as being a referendum on his policies. So if the markets respond in a positive way, that will give him encouragement. If the markets react in a way that they don't think his policies are going to be effective, he will, I believe, move and pivot away so as to engender the best possible growth. And on tax policy, I do expect things like the no tax on tips, no tax on overtime, real kind of blue collar issues with which he attracted significant voter support to ultimately be passed. So, the Trump policies will resemble 1.0 in that median household income across the income brackets did extraordinarily well in the 3 years prior to COVID. In relative terms, they did better at the middle and lower tier. That's something I know the president was very proud of. So how Trumponomics exactly gets implemented remains to be seen. But I do think, Bilal, as I look for growth this year and next, I understand why the animal spirits were so positive following the election. And in my forecast, I'm actually pretty constructive on the economy.
And just on that positivity, a lot of economists have real problems with tariffs. It seems. I mean, on fiscal, there's a debate. As you'd expect, but it seems like on tariffs in particular, lots of economists have come down hard on Trump's policy, sort of saying that goes against comparative advantage. It's going to lead to inflation, stagflation, all of these sorts of things. How do you sort of take those sorts of comments?
Well, Bilal, you and I are very good friends, and I'm going to tell you because I read it. Don't read the FT, because you're right. If you read the FT, everything in tariff is bad. Tariffs are neither good nor bad in theory. There's consumer surplus that's lost. There's producer surplus that's lost. There is some deadweight loss associated with tariffs, but the net revenue to the government is an offset, and tariffs can be used very productively. So like with everything, it depends the context in which tariffs are used. if you are looking to compete and level the playing field, tariffs are a necessary tool to move us in the direction of reindustrialization and protecting nascent industries, such, for example, as the AI space. And therefore, if you're so it depends how the tariff is used. And given what Trump wants to accomplish, I don't see how tariffs can't be used. Tariffs are not inflationary; they're price level adjustment. Inflation is a monetary phenomenon, and the Fed even in 2018 had said, look, if we have tariffs, we look through those price increases because they don't bring about inflation. And actually, in the case of China, we actually found, ironically, when those tariffs in China went up, that it was absorbed in the currency and in the margin, and prices from China actually fell. Now, this time around, there might be a price increase, but I don't think tariffs have taken on this they've connoted this negative inference, and I think that's completely incorrect. And I think, unfortunately, Bilal, that reflects the politicalization and divisiveness of everything. I have a feeling that if the one party had proposed it instead of the other, they may not have the same reaction to
Yeah.
what's trying to be implemented.
No, that's a fair point. The other, point on the economic side is on the supply side, labor supply side, where, the increase in labor supply over the past couple of years, largely driven by immigration, legal or otherwise, has really helped. There's a view that's helped the economy. And so the question now is if
Yeah,
we scale that back, then labor supply goes
right.
down, you get hit to
But
growth.
yeah, I mean, the problem here's the thing with the immigration issue, and that is that various estimates, depending on, it could be anywhere from 10 million to 15 million or upwards in the last 4 years. I don't know what the exact number is. I mean, these are estimates, but clearly it was a large number to your point. And ostensibly, some of these people did find their way into the labor market. The problem, Bilal, is if you look at the data that we have, it's not clear what the immigrant effect was because you can't see it. So, for example, if you look at the establishment data, which are benchmarked to what employees pay unemployment tax on, it covers about 95% of everybody working. We actually found last year, in the early part of the year, that we actually had significant overstatement of employment, and those numbers were revised down. If you look at the household survey, which actually doesn't go to companies, but actually goes to individuals, and you look at employment there, you actually find that household employment consistently has been running under the payroll data. So when I look at the broad employment numbers, I don't really see as much growth as what was previously reported in the previous handful of years. And what I see now is labor force participation, the measured numbers slowing. And therefore, I'm not really concerned that somehow there's going to be a lack of immigration in a way that is going to push wage pressures higher. Number one, wages don't drive inflation. Monetary phenomenon drive inflation. But to the extent the Fed looks at those wage trends, what we're seeing is falling quits rate, and we're seeing rising job openings, and we're seeing broad wage trends as measured by the employment cost index, and other figures show a pretty noticeable deceleration. So I think, unfortunately, people have taken the immigration issue and gone too far with it as it relates to inflation. If we're going to get inflation down, a couple of things need to happen. Number one, oil prices need to drop. I think oil prices will come down. I've gotten a bunch of pushback on that. And in the past couple of months, we've gone from roughly 75 West Texas down this morning to $68 a barrel. If we could increase drilling and increase that supply, which is related to your supply side comment, energy costs could take upwards of 125, 130 basis points off your inflation rate. That's a big number. If we could increase productive capacity by encouraging companies to expand further, and that happens with making the 100% expensing of the 2017 tax cuts permanent, that will certainly help. Trying to shorten the permitting process, which takes sometimes an inordinate amount of time for companies to build new plants and factories, that will help. And of course, lowering the corporate rate further from 21 to 15% to domestic producers, which the president wants to do, that will help. So again, you have to have tax policy that's trying to focus on the supply side or the productive abilities of the economy to get that to grow. And then inflation will come down, and then rates will come down, and that will offset some of these tariff concerns. I'm not a Keynesian economist, so I think a lot of the criticism on tariffs and the president's proposals focus way too much, Bilal, on the demand side, and need to focus more on the supply side.
Okay, yeah, no, I see where you're coming from. And so for this year, then, inflation, we saw the most recent inflation print, the CPI print at least, came out a bit high. It seems like we're running around 3%-ish or,
Yes,
at the
yes, that's
moment.
right.
So,
Yes,
so
yes.
where do you think we'll end up by the end of this year, say? Like, what's your base case on say,
The
GDP as well?
So GDP, the first 3 years of President Trump, we were 2.8%. Productivity started to accelerate under President Trump and continued over the past 4 years, helped in part by the big AI boom, which I do think is real and is helping. So to get a number that's marginally higher than 2.8 to me is very reasonable. 3%, 3.1, even 3.2, like three something to me. That to me seems like a very good number. We do expect inflation to drop. I'm less confident in inflation because what we're seeing is sticky prices. I argue last year at the time it made sense for the Fed to cut 50 last September, but those successive cuts weren't necessary. They were imprudent. Unfortunately, rates were cut further. That's hurting a bit. So I do get a bit worried, Bilal, that on the inflation side, while I do think inflation will moderate, we certainly need lower oil prices. We need to increase productive capacity, but it might mean that inflation doesn't get down into the low twos as soon as I'd like. That would be a risk. But I will say inflation should move down from, high twos, three, depending on which series you're looking at, into the low twos, which over time should allow the Fed to cut rates. And I think next year, if the president can get the tax policies he wants in place and we can get some of these spending cuts, which I think are doable, down, then I do think we could see inflation move lower in 2016. So I'm constructive, but I am worried on inflation is the bottom line.
And you said the Fed may cut this year. So is that your base case? They cut this year or?
Yes, they cut this year. The market right now is assuming, I think they're worried a little bit too much about growth in the short term. I'm not sure exactly why. Maybe it's a mistaken view of tariffs. Maybe it's just overseas weakness. The market has easing priced in July, which I think is much too soon. But I do think if inflation does moderate and it looks like future prices are going to weaken going forward, meaning you get to middle of the year, second half, early second half, and inflation is coming down because of oil, and people get more confident in the outlook that the price trends aren't as sticky. Then I think the Fed, you can see them easing late in the year, and then of course continuing that trend in 26. Because right now I look at the yield curve, which to me is still much too flat, and it would make the most sense to me. It would jive more with the historical record of short rates coming down more. So both short and long rates decline, but short rates fall more as the Fed eases, and those long rates get down to 4%, maybe even slightly below sometime next year.
And then on the fiscal side, there has been concerns about, the size of the fiscal deficit. People have talked about maybe the long end's, going to be affected by it. These tax cuts that have been talked about could blow out the deficit. I mean, how do you think about, fiscal issues, fiscal risks,
Yes.
debt issues?
So a couple of things with the CBO, Bilal, I've got a few problems with their estimates. Number one, they're assuming in the next 10 years GDP growth of 1.8%, which is terribly pessimistic. So obviously that's going to net you significantly less revenue than if growth is stronger. So that's one problem. They're too pessimistic on GDP. They also assume that big tax hikes, which are going to go into place next year if the 2017 Tax Act isn't extended, will push the revenue share of GDP, which is already slightly above its long-term average, up. And that's highly unlikely because what's more likely to happen is the economy will weaken and revenues will be less. The problem we have is on the spending side, where the revenue share of GDP looks good. It's the outlay share of GDP, which is off kilter. And this is where DOGE comes in. I don't know exactly what the ultimate spending cuts will be, but we could look at the congressional watchdog, the Government Accountability Office, and they've written numerous reports over the years that anywhere from 100 to 300 billion per annum could be saved if we could eliminate waste, abuse, and fraud. And that may be something many administrations have talked about in the past. But it seems to me that is this novel approach, DOGE, which may actually implement some of these things, which I believe ultimately are going to be bipartisan. Because if you could save on the waste and the abuse and the fraud, that allow you to do many other things. And even 100 billion per annum in reductions gets carried forward 10 years. That's $1 trillion in savings. So if I look at the savings side, I do think it's much more legitimate than many of the market cynics. We know people in this business tend to be cynical. I do think there's real opportunity to make those cuts. And I would also argue if we try to break down why the yield on the 10-year has fallen over the past 6 weeks or so, it's been largely low return premium, which I do think is associated with, wow, DOGE may actually work. And then, of course, those nervous Nellies, those pessimists now say, oh, but if DOGE works, we may have a recession, which to me is, I think, is totally incorrect. But you can see how the narrative goes from one pessimistic story than another. Maybe I'm too optimistic, but
I mean, just on the waste. I mean, one criticism I've heard about DOGE is that they're basically, yeah, they're cutting the sort of the federal workforce, which over time has been declining anyway as a share of overall employment, and
yes,
they're cutting people who are easy to sack, not necessarily the people who aren't very good. And so there's going to be this capacity or effectiveness issue, and instead the spending problem is at the entitlement level. It's just the huge healthcare, defense. I mean, if you don't cut
sure,
those,
yeah. Well, here's the thing. I don't know, Bilal. I mean, the people who are getting laid off, my understanding is I don't know what the exact specificity of it. I know some people are the most recent joiners.
yeah.
Maybe they don't have as much human capital because they haven't been there as long, so therefore aren't the most productive. So I can't speak to the specifics. And you are correct. Most of the money is on the entitlement side. But again, even there, as the GAO had cited, they were in one of their analyses, they looked at the amount of payments, the misappropriated money for Medicaid, even unemployment insurance. So that's somewhere you want to look. But on the federal side, as you talked about the federal workforce, I think, again, this is a broad-based approach. You just can't deal with the spending without also potentially dealing with the workers, and other areas that the economy be better served with those activities being done in the private sector versus the public sector. If we look at GDP, though, and we look at the federal government share of GDP as measured in the NIPA accounts, the GDP accounts, it's about 6%. But then when we look at the federal budget, which includes everything, non-GDP related type spending, it's over 23%. And that gap has been widening, which just tells me that probably the inefficiencies of the government have grown massively over time. And what DOGE, I think, will be successful in highlighting are many of those inefficiencies. And to the extent we can cut those out of the system, you're going to get interest rates that are going to be lower. That's going to support asset markets, housing, equities, and you'll get the benefit from easier financial conditions. Even if in the short term there was a modest negative hit to growth, the markets are going to look through that if these spending cuts are for real. Because as you know, we're on a very unsustainable course. And I think that people are being unrealistic in thinking that, you can't break some glass along the way. I don't know how any other way you're going to get some of this stuff done if you don't take kind of a very aggressive approach, which is what DOGE is doing. That's to say they're doing everything perfect, but I think the intent is correct, and I think they'll be successful.
Yeah, and you touched on the Fed earlier in terms of some of the cuts they did towards the end of last year were not warranted. I mean, more generally, if you step back, how would you score the Fed? I mean, in terms of how they've done post-COVID.
Good question. I mean, I say in general, I mean, they did an excellent job during the pandemic providing the liquidity. They clearly were too slow in removing the liquidity, and so I think they made some mistakes there. I don't know what the grade would be. I mean, I don't want to give them a failing grade. I'll be an easy grader, Bilal. I'll say they get a pass. But I like to see.
I mean, obviously, the level of difficulty was quite high as well.
Yeah,
I guess.
yeah. I look at it this way. I think what matters more is, okay, what happens going forward instead of dwelling on the past. I mean, I think the Fed realized that, Chair Powell, that inflation wasn't transitory. I think they realized they made a mistake. They would say wouldn't score well on that, but they scored very well on everything since then. I would say more recently I'd give them better grades because they now have kind of dialed back on the projected easing. I think they're more cognizant of the fact that easing they did was working against their intentions because they were cutting rates and further galvanizing financial conditions in a way that was not taking liquidity out of the system to try to get some of the inflation lower. So I'm optimistic they'll make some changes. There are going to be a bunch, as you know, a bunch of new appointees that are likely to come in the next few years. So I do think there could be obviously some meaningful changes. What I like to focus on though is what does the Fed do from here? And I think right now the best approach the Fed can do is just stay on hold, take a holistic, pragmatic approach with the tariffs. Do not look at these tax cuts as themselves being inflationary, and look at more the supply side of the economy, the success of Trump 1.0 versus these dynamics. Was it dynamics? Dynamic, uh, stochastic general equilibrium models, which don't work. And I think that they had to be a little bit more discreet in that way, and everything will be okay. Which is a
Yeah.
long-winded way, Bilal, of saying I'm optimistic they're going to do a good job, but we'll see. Um, anyway, I don't know
Yeah,
if I
no,
was
that's fair.
clear
That's
enough.
a fair
Yeah.
characterization. No, that's great. And we've talked a lot, obviously, about the US. I mean, what do you think about the state of the rest of the world? China, Europe.
So, I mean, China to me has so what I like about the administration's approach is that they don't want to cut consumer spending. What they want to do is lift production relative to consumption. So the economy continues to grow. It grows at 3%, 3% plus, but it's because you've got rising production, because you've got strong income associated with high value added manufacturing. That's a good scenario. The problem with China, the way I see it, Bilal, is they've got much too way too much production. They've had export-led growth strategy and very little consumption. And I don't see anything at the moment that's going to change that gross misallocation of capital, which has been consistent for the better part of the last 2.5 decades. I don't see that changing, and therefore I'm pretty pessimistic on China's growth prospects. They're not going to be able to export to the same extent to the U.S. they have in the past for obvious reasons. And I don't think they're going to export as much to Europe, certainly not Germany as they have in the past. In fact, if you look at German industrial production, it's essentially, excluding COVID, at its lowest level since the spring of 2010. So they've had a meaningful, in some sense, hollowing out of their manufacturing base because they can't compete, in part because of their dramatically high energy costs. And as you know, on a continent generally that doesn't have much, you know, per capita productivity growth. The productivity trends are terrible. In the UK, as you know, they've been horrible since the pandemic. So I look at China. I worry about China, Europe as well. I know the equity markets in Europe have done well. I think that's a technical move in some sense. Maybe there's going to be some growth, but I mean, right now I don't see it fundamentally. The one area we are bullish on is Japan. I think Japan is making some real structural improvements. I think it's an area that's going to continue to attract interest and capital. But I'd say the general macro economy globally outside the US is not particularly robust, which also will make me, again, at the margin, more sanguine that inflation is going to move lower because I don't see anywhere in the world that is generating massive inflation. It's in quite the opposite. It's disinflation.
No, that's fantastic. Now, I just wanted to round off our conversation with a couple of personal questions again. One was, I know you speak to lots of investors over the years, and what, if any, what's the best investment advice you've ever received from anyone?
I would say, anything I've read from Stan Druckenmiller is always the most fascinating. And I'm going to paraphrase, but he said, strong convictions loosely held. And I think, Bilal, you were a well-known strategist on the street and you saw the same people I did and were incredibly well thought of. And I think, you realize that, you don't want to be an elevator, go up and down with your views. So you have to have a well thought out narrative that has assumptions that make it very logical. And I always say, well, what changes the assumptions so you can pivot and not stay with a view too long? And it becomes very hard. So I think that was probably the best comment about markets. And of course, just a general fact that many, many, many investors have said this, and as well as anyone, it's the markets are humbling, but they're fun because they're always changing. So you kind of have to keep an open mind and as I try to, I'm generally an optimist. So maybe that maybe I don't want to be too biased on what the administration's trying to do, but I do think it worked because it worked the first time around, and there are risks in its implementation. But I'm generally an optimist. It's hard to be in this business, and there's a lot of cynics in our business, but it's hard hard to, if it's just easier to come to work when you're an optimist. So I think, try to keep things in perspective is always important. Oftentimes easier said than done, but try to take things as they come and not get too worked up one way or another. Although I have to admit, sometimes it's difficult.
Yeah, no, I hear you. The other question I wanted to ask you, we do have some young people listening to the podcast as well. So what advice would you give to students who will leave university or college this year and enter the real world?
I read as much as you can because, in the old days, you get the newspaper, I'd get the New York Times and I'd get the Wall Street Journal and the Economist and Business Week and any foreign affairs and all the major media outlets. Now there's all these great Substacks and the alternative media, which I think is in many cases much better. But read as much as you can, develop as much depth on the subject matter you're of interest in, keep an open mind, and ask a lot of questions. Always be intellectually curious. And if you're still in school, take some classes that might be hard, but importantly, find the teachers that are interesting. Like you'll find subject matters if you actually have a really good teacher that can make a statistics class interesting. But because you do want to take some kind of core classes. So if you're doing economics or finance, you'll want to take those classes just to build some foundation. But read as much as you can, ask as many questions as you can, be intellectually curious, be open-minded, and let serendipity take over, because what will wind up likely happening is wherever you get your first job will not be where you end up. And it's the journey that could be quite fun. And you're going to make mistakes, and that's okay. Just learn from them.
That's great. And you mentioned reading. So are there some books that have really influenced you over your career, or some books recently?
The best book, the book, my favorite book was Reminiscences of a Stock Market Operator, about as a quasi real Jesse Livermore. That's just a fantastic book. And what you realize is, even though you're reading it and you're talking about the ticker tape, markets don't really change much. Fear and greed really drive things. That's a fascinating book. And that, a lot of other investment type of books that are great. But that's the one I think everybody should read. It's an easy read, and it's absolutely fascinating. It proves, Bilal, how much the more things change, the more they stay the same. You've got all this great technology, but markets are markets.
Yeah, that's fantastic, Joe. Now, finally, what's the best way for people to follow your work or connect with you?
That's an excellent question. I am on social media. I'm on it a little bit. I'm trying to figure out a way or I could be more actively involved. I want to make sure I'm clear on all compliance related matters and things of that. Perhaps I could let you know. Maybe you could post it in the bottom where best to find me. Yeah. I feel like I don't want to give an email address, only because worry I'd get too many emails. But
and you're on TV a lot as well, I guess. As well.
Yes, yeah. I'm lucky. I get to do a lot of TV. But let me get back to you on that. And then, because I'd like the brand more if I can, and I'm very thankful for being here with you today on that. So I will revert on that.
Great. No, I appreciate that. Well, with that, thanks a lot. I mean, I've learned a huge amount, and it's fantastic to hear your thoughts on Trump and everything. It's a kind of a refreshing perspective from many of the sort of speakers and economists out there. So, keep up, the great work. And
Thank you, Bilal. I'm going to see you in London, I hope, in a few months.
Absolutely. Yes.
Thank you.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.